Good morning, this is Larry Edelson for my Uncommon Wisdom video for Thursday, April 22nd. So far this week we've seen considerable volatility, kicked off largely by the news that the SEC is charging Goldman Sachs possibly with fraud. That is a significant investigation. It's hardly surprising to me, and it's probably just the tip of the iceberg. However, I do want to point out here that fundamental news like the announcement of the SEC investigation with Goldman, those things don't drive the markets. And we can see a perfect example of that in gold. Over the last couple of weeks I've been telling you that gold needed to close above $1,162 for it to signal the next leg up to record new highs. And gold didn't do that. In fact, gold a couple weeks ago came within 90 cents of that signal, but still shy of it. And it did not execute that technical and cyclical signal that I told you about. That in itself was telling us all something about gold. It was telling us that something out there was preventing gold from breaking through, from the lid coming off of gold. And also, we saw it in the Dow. With the Dow, my resistance area at 11.2, the Dow was unable to get above the 11.2 level. And quite interesting, gold tried again at 11.62, and the Dow tried 11,200 just before the Goldman news hit. And then, of course, the Goldman news hit, and what did the markets do? They all sold off quite dramatically and quite sharply. So that news about the Goldman event actually was the fundamental news or the excuse for traders to sell, but the technical signals told us that selling was going to be coming in there because both those markets, gold in particular, failed to generate those buy signals. So it's just an interesting example of how technicals can and cyclical events in the market can often foretell the news, or at least the news environment and the background environment in advance of the actual event taking place. As far as the Goldman investigation goes, as I noted before, it is the tip of the iceberg. I believe it will probably get ugly. It will spread to other investment bankers in the industry. It's all the aftermath of the real estate crisis, and it's part of the future for these markets because, as I've been telling you, the cyclical posture of the United States economy right now and U.S. markets is very ugly, and it's going to get even uglier for the U.S. economy over the next few years. That does not mean that everything that's traded is going to just collapse. Quite the contrary, the knee-jerk reactions will be always to sell when there's bad news. But some of these developments will actually, let me just back up for a minute. Take gold, for example. Investigations on Wall Street pitted against Washington, Washington beating up Wall Street. That's not bearish for gold. That's very bullish for gold. Stock market, negative news isn't always bad for the stock market. If we continue to see the long-term decline in the dollar, that will be more important than anything that's going on in the boxing ring between Wall Street and Washington. And we'll see investors flock even to high-quality stocks as stocks longer-term inflate on the back of a dollar depreciation. We're not there yet. The stock market is, as I indicated before, in a topping mode. We'll see a downdraft into late summer, but then it will start to reinflate again. And a few years from now, we'll be looking at record new highs in the Dow. Let's go quickly to the gold chart. This is pretty much the same gold chart that I've been showing you. I cleaned it up a little bit. There were getting too many lines on there for you to see my main points. Here is the 1162, 1163 area. The gold market failed to close above that level. Came back down to test cyclical support off the previous record high at 1227, and it is holding. There's also uptrend cyclical support here that is holding. We'll probably see gold move back and forth now between 1160 and 1110 on the downside over the next couple weeks. But the next moves here are either going to be a solid close above 1162, which is your signal that new record highs are coming in gold, or the market might get pulled down to this intersection here, and we might see gold close below that. If we do, there is going to be some downside in gold. Probably back down here to this inverse head and shoulders formation at the 1080 level. So short term, the gold market is still gyrating pretty wildly, but the bias is still to the upside, and the long term trend for gold is massively higher. Let's go to the dollar, which of course is very related to gold. Dollar's still doing pretty much what I've been telling you it would do, chopping back and forth on this dollar index between 81 and change to 80. Next big moves here are going to be similar to gold. If the dollar closes above here, we could see a new high on this bear market rally for the dollar. If it trades back down, we could see it fall back down to the 79 level. Overall, next couple of months in the dollar, I don't see anything but choppy action. And we'll probably see the same thing in gold over at least the next few weeks. However, bear in mind, gold can move up even as the dollar goes sideways and even as the dollar goes lower. As the dollar strengthens. We've seen that many times in the last couple of years as problems and worries in Europe about the sovereign debt situation there drive investors into gold. Gold can rally even as the dollar strengthens against the euro. So don't have any presumptions right now about the dollar-gold relationship. It can change. And gold does not have to always fall if the dollar rallies. Let's take a look at the Dow. Okay, same chart I've been showing you all along. Let me see if I can pull it down here for you. Give me 1 second. There's a couple of things I have to do. There we go. It's a little bit small. I'll make it a little bit bigger for you. Notice how the Dow here, we got 180 point sell off on the Goldman news, but the Dow rallied straight back up above this support line that it almost penetrated on the Goldman news. You can see there's 1, 2, 3 pretty important cyclical support lines underneath the Dow, and the only thing really above it is this cyclical trend projection line that currently is about 11.8 and rises gradually over the next month or so to 12.2. As long as the Dow holds in here, in this current 10.8 to 11,000 level, as it appears it's doing, we could easily see a run to new highs in the Dow here, post-recovery highs, up to that 11.6 area, which is system resistance on my models, and possibly even 11.8, possibly even 12. Little too soon to say, but the market is acting rather very well. It is late in this rally. That's why I'm not recommending aggressive stock holdings in here, except for natural resources, because we could go up to 12, which is, okay, another 900 points higher. It's a pretty big move, but there's about 2,000 points of potential downside going into the summer. So I'd say 900 points maximum on the upside versus 2,000 points of potential downside. The risk is shifting to the downside for the next few months for the Dow. That doesn't mean you should run out and sell everything. That doesn't mean there are not opportunities on the upside in the Dow. There are. I would just be a little bit cautious here. We are late in this post-recovery rally, and a correction is overdue. It's just a question of from what point it will start and when. I think we'll see a thrust higher, and then the correction will begin. And of course, I'll keep you posted as always in my column. And for those of you who are subscribers to my Real Wealth Report or my trading services, of course, you'll always find my recommendations and detailed thoughts there. Till next